morning, one important stock that we are tracking is Dr. Lal Pathlabs because Credit Suisse has initiated coverage on the counter with an underperformed rating, and they are talking about a downside of almost 40%. To discuss the thesis of that report and to understand how business is really placed, we are now joined by Mr. Prakash Manchanda, the Managing Director at Dr. Lal Pathlabs. Dr. Manchanda, thank you so much for making time and speaking with ET now. First, I wanted to understand from you, Credit Suisse believes that margins are likely to be under pressure going forward. What's your take? Because if I see your numbers at the moment, the margins are hovering around that 25-26% band. Where do you see it by the end of the year?
Good morning. I think there are basically two headwinds that are being perceived. One is this year entire industry is up against a very high base of COVID of last year. And early this year, sometime Feb onwards, COVID has sharply declined. And that is impacting the margins for the entire industry. But having said that, I think we are going back to our margin trajectory of pre-COVID levels. The last 2 years, margin actually went up primarily because of very high sales on account of COVID. So I think that's one headwind which industry is facing in FY23, which I think is more or less getting corrected now in the last 4-5 months without too much of COVID sales in our base. Second headwind is, I think, is rising competitive intensity, which is coming on account of many players that are entering in this space. And I think my view on that is that this is definitely going to grow the market, especially on the screening side and wellness side. And there is a perception that this may put pressure on the margins. But having said that, we've said in the past, to the best of our ability, we'll try and enhance the value proposition rather than take the pricing route. And I think these are two real headwinds which are being perceived in the industry today.
Part that you mentioned about high base and margins, but what would you say about the investments that you have to do? So you've done an acquisition, now you're focusing in on South to increase your network. How will the OPEX really have an impact?
See, basically, there are two means to grow this business. One is, which is traditional one, keep on growing organically, but that has its own limitation because that growth actually can come from those markets where your brand franchise equity is very good, strong. And for us, those markets are northern and eastern markets where we have been really pushing organic growth agenda. I think the markets where our brand is relatively weaker is especially South and Western markets, and this acquisition that we did recently was to plug that gap. And we continue to evaluate inorganic opportunities as they come. But for us, actually, both paths are open, both organic as well as inorganic. So the investment actually is going to, on the organic front, is primarily in the area of opening more and more labs, and inorganic, of course, as and when some opportunity comes up.
There seem to be some concerns as well when it comes to the ramp up of digital health. Actually, those platforms, the ramp up slowing down, as well as the effective retention of patients via the loyalty program. Is that a concern for the company as of now?
Not really. I think we fairly well know that the frequency of purchase in healthcare is not that high as normally one tends to perceive. It's not a daily use item or a monthly use sort of a thing. I think the purchase frequency sometimes runs once in a year or so. So obviously, for a performance of any business, one has to see not on a quarterly basis, but on a multi-year basis. And I think we are fairly strong. We are very confident that retention rate or loyalty rate for our brand is very, very high because essentially trust is the main pillar on which you attract the customers. And in medical side, you really don't want to go with other brands just because some brands are cheaper, etc. But to my mind, I think the value proposition on the quality side has to be very, very strong for any brand to be successful.
Now that point is taken, but could you talk to us about how the volumes are trending for the non-COVID testing, as well as what's the realization per patient, etc. Because you did talk about that margins are heading back to the pre-COVID level, but if you could help us quantify what that range could be.
So I think that's a great question because our focus for last couple of quarters has been essentially on non-COVID, and that's the way one should evaluate this business going forward. Because COVID, I would say it's a one-off event that took place. I think gradually we are seeing a recovery. The first sort of a target for us was to go back to pre-COVID levels in absolute terms, which I think we have achieved last year itself. So we are tracking much above the above what we used to do pre-COVID levels on non-COVID. But now we are looking at, are we inching back to the same growth levels what we used to have pre-COVID? I think recently we did this analysis of CAGR of from FY19 onwards, because those days there was no COVID. So I think that CAGR is now hitting double digit, I think nearly about 10%. And if you look at historically pre-COVID levels, we were ranging between low teens to mid-teens. And I think my sense is we are gradually inching upward to that number, of course, on a higher base now. But let's see. We are hopeful that we should go back to that growth level quickly.
Thanks for alleviating a lot of those concerns and walking us through the company's growth outlook. That's the view coming in from Dr. Lal Pathlabs.